Justin Pulitzer. This is my Risk Management 101 Price is Truth Special Edition video. And really the purpose of this video is to explain my views on managing risk. The common belief that I notice on television is mostly buy high and then puke it out low when it goes wrong. Now that isn't a strategy, that is a recipe for disaster, and for that I've created the 10 risk management commandments. So I'm going to just tick through each of these and then elaborate on it as we go. So let's get going. So number one, you shouldn't be involved in every move in every stock. And there's a great quote by Jesse Livermore from Reminiscences of a Stock Operator that I think captures this well, and it's, you can win a horse race, but you can't beat horse racing. Now, all the intelligentsia on TV and the Twitterati always are right every time in every stock for every point. That is complete BS. And the truth of the matter is you have to be cold and calculated and have to narrow down and focus in on a certain narrow group of stocks and pick points into which you can kind of game the trade and have an edge. So keep that in mind when we go through the rest of these. I just want to let you know that that is BS, and don't ever let anyone tell you that they've caught every move in every stock. It's unrealistic. So with that said, price is truth, the trend is your friend. Check your bias at the door and go with price. Keep an open mind and be flexible. The market will show you the way if you're open to the information it gives. And I discuss often on the stream write or write out trades at trend lines or channels for that matter. Reference highs or lows, which are the levels. Fibonacci retracements, the most important which being the 61.8, and major moving averages being the 20, 50, 100-day MA and 200-day MA for the most part. So what does this mean? It means a lot of people come in and they have a bias on a stock, for example. They can only see that it's going up or they can only see it's going down, and they'll often negate the fact that the stock is showing signs of either strength or weakness, and they basically go with their opinion. My view on that is it's good to have a fundamental bias, but more often than not lately, the technicals are what is important. That's what all the algorithms and that's what all these mostly traders see. So trading is very visual, and if you really just keep an open mind and you just focus on what is happening, not what you think should be happening, you'll get the information and you'll see if a stock isn't acting right or if the market isn't acting right. For example, if a stock should be going up, it's getting all these upgrades and the news has never been better, but the stock keeps going down, the price is telling you something. You're not correct. The price is the ultimate arbitrator. Always remember that. A lot of people trade and are resistant to taking losses because they always want to be right. That is not what the name of this game is. The name of the game is making money. That is the ultimate being right. Just always remember that. If you're not making money, you're wrong. If you're making money, you're correct. That is just it. That is plain and simple. That is the way this game is played. Failing to plan is planning to fail. Plan trades ahead of time and don't hesitate when your level is hit. A lot of the time people come into the day and they're just going to buy whatever is being talked about on TV or short whatever is already gone down. This is not how it works. You have to do your research, your chart work, all the homework ahead of time. Have your plan of battle mapped out. You wouldn't go into war without a plan. You wouldn't just show up one day and say, hey, we're here to invade. You'd get your butt kicked. Same thing in the market. Go over the charts, do the research, realize when earnings are. A lot of people don't realize that, and they get their throat handed to them because they're in a position and they don't realize that it's going to gap huge the next day for or against them. Always have your plan ready. Keep your size right at order entry. Starting right helps to buy right or short right and then sit tight. This is very, very key. A lot of the trouble that people get themselves into in the market is that they start off with a size that is way too big and they get themselves in trouble when it goes against them. If you plan your entries and exits correctly and you're in the right size, You'll be able to sit tight if the trade goes against you a little bit in the beginning, or if it's going your way correctly in the beginning and then it goes against you a bit, you're not going to panic out. Just keep your size correct. Size is what kills, particularly in a market that gets very volatile, particularly on the way down. Stocks tend to take the escalator up and then the elevator down. People usually aren't prepared for this. All they can see is, how high is the sky. That's not how the world works. That's not how the market works. Keep that in mind. Never add to losers, no matter what TV personalities may say. Averaging a loss is dangerous and just bad trading. Every ad should be at a higher price than the initial buy or a lower sale than the last if you're playing short. So what does this mean? A lot of people like to try to feel for the bottom in stocks or like to try to pick for the top. This is okay if you are using a risk management strategy with a tight stop, but if you're wrong and a stock is going against you, you don't want to buy again until you're showing a profit. More often than not, you won't be able to pick the bottom and you'll just be adding into losers. You do not want to do this. You want to add to winners. Think about it like this. If you ran a clothing store and you bought a bunch of shirts that didn't sell, you'd have to mark them down, correct? To get rid of the inventory, basically supply and demand. You wouldn't go back to your supplier and say, hey, give me more of the shirts that didn't sell. You would tell him, hey, I've got to mark these down. Give me something that works, something that's sexy. You have other shirts on the other pile that are sold out. You're going to want to get more of those. Think of it like that. That is how the market works. That's how the world works. Just that's how it's done. Take profits along the way, but let winners run and cut losses fast. Honor your stops. Okay, let's discuss this. We never know when the top is. We never know when the bottom is. That's why we book some profits along the way at key points. If a stock is up or down 5 days in a row and you're long or short, book some gains. Just do it. Let the winners run and then cut the losses fast. So, like I said, you want to most of the time, a lot of people take on trades and they don't have the imagination to see it forward. That the trade, like let's say a stock, their target is 100. They don't see that the stock can go to 100 or 130 or 150 if it's at all-time highs in clear air. This is very often the case with stocks. They tend to have parabolic moves toward the very end. That's when most of the gains are made. But you'll be out, with your $5 or $10 gain when you really should have made $50 or $60. Same thing with losses. Oddly, a lot of people get very fearful that they're going to lose their gains, but then get very hopeful that they're going to get their losses back. If you have a point, 2 points, it's no big deal, it's just a flesh wound, and then you're sitting on a 50 or 60 point loss when you should have taken the hit. A lot of times we know the right thing to do, we just don't want to do it. That's why, in a cool and collected fashion, before you're into battle, set your stops so you're not going to be in panic mode and hit the button at the wrong time. Always have your plan. Never be at max margin and never meet a margin call with fresh capital. Close out. Capital is your fuel and margin are your bullets. Run out of either and you're dead meat. So let's discuss this. I encourage everyone to do a Google search of what the geometric series is, and that is basically how margin works. It is wonderful when you're on the way up. It is absolutely devastating and will blow up your account on the way down if you do not manage this properly. I can tell you this. If you're getting a margin call and you have to pump in new capital, the chances are the stock or whatever you're in, the commodity, are going to continue to go against you. You do not want to put good money after bad, as the expression says, and that's basically what meeting a margin call with fresh capital does. Excuse me. So basically, I would suggest know your account size. A lot of people start off with smaller accounts and they want to be, Carl Icahn or George Soros overnight. And they're going to lever up their account and they're always at max margin because they want the money fast. These people never seem to make it, do they? The trick to managing your account is to not be at max margin because you're at some point going to have something happen that you didn't anticipate, and you may have done great for a year or 10 months, and then you'll have one big whoosh that takes it all away from you. Don't be at max margin. Trust me, I've learned this lesson the hard way. I have friends of mine who've learned this lesson the hard way. You just don't want to do it. You want to be at the correct size. Which gets back to your losses. Never drop more than 10 to 15% of your total account value. If you drop 10%, it only takes 11% to break even, to get back to even, basically. And if you lose 15%, it takes 18%. It starts getting increasingly harder as you go from there. 25% takes 33% gains to get back to even. A 30% loss takes 43%. And if your account gets cut in half, guess what? You have to get to 100% winners to get just back to even. You should get the point. You should get the point by now. Keep losses small. I think this is pretty self-explanatory, and just keep your losses small. Keep the total account at 10 to 15% max. Once you get past there, just close out. You're not right. The market's going against you. Your strategy isn't right. You're not in the right stocks. Whatever. Just get out. GTFO. That's get the F out, basically. Let's move on. 9. Always trade from a dispassionate point of view. If your heart's racing, you're probably not going to make a clear-minded decision. This likely goes back to 4 when I talk about having your size right. The aim is basically to be cold and calculated, like a machine. You want to plan your trades. You want to know your entries and your exits. You want to execute, not from a place of emotion when you're not thinking clearly. You want to do it like a cold machine. Basically, the algorithms operate this way. You should be operating this way. We are people. We unfortunately do have emotions sometimes when it comes to money and trading and biases in stocks. If you notice yourself doing this, start taking notes of things. When things go badly, mentally note, hey, I was thinking like this when it all went bad, or hey, I was thinking like this when it went right. Just take mental notes. You might even want to keep a trader's notebook with you, a little dossier, if you will, of how things are going, and recognize those tendencies in you so when you can spot them early so that you don't have to pay your tuition the second time. It is annoying to have to pay it the first time when you lose out, but if it happens again a second or third time, it's even more frustrating. And you know what, as the old saying goes, wrong me once, shame on you, wrong me twice, shame on me. Don't be the victim of this again. This one is really critical. It doesn't get talked about a lot because most of the people on TV always have a vested interest in having you in the market at all the time at max level. Your broker won't tell you this because their goal is to gather as many assets as possible. But remember to take money out of the market when you have big winners. You never know what tomorrow will bring. If you're up and you've been on a huge winning streak, take out some money, man, or ladies and gents. You have to have bills to pay, you have rents to pay, you have phone bills to pay, so on and so forth, car payments, kids, alimony, maybe. Just always think about what can be coming down the line and the money you need to live on. When things are going really well and you have a lot of profits, just take a little bit out, put some into your account, your regular bank account. You could always put it back in at some later point, but it is, in my opinion, and this is what I've been practicing for years, take some money out to live on and save it for a rainy day, so to speak. It may sound like a grandma or what have you, but guess what? They live to that ripe old age for a reason, and they usually have a lot of money. So these are my 10 risk management commandments. If you follow them, you'll do pretty well, I would say. And if you have any questions, feel free to follow me on Twitter. I respond to them, and have a good day, and cheers.